Welcome back. Still watching Business Morning for commodities market update. Now, we see oil prices drop today, reversing gains in the previous session. U.S. West Texas Intermediate crude futures fell 43 cents at about $76.32 a barrel. We see Brent crude futures fell about 30 cents to $79.40 a barrel. All right, now we have Anosike Nwajide, research analyst, financial derivatives company, breaking it down for us. Great to have you on the program. Good morning.
Always my pleasure.
Yeah, so we've seen our oil prices lose the $80 mark, down about 8% in the last month. Shall we say the oil bull market is over now?
It remains to be seen. It remains uncertain. The U.S. and China have taken or deliberating on taking drastic steps to curb further rises in prices. I mean, the U.S. President approached OPEC sometime earlier this month, saying, asking if it could say increase the pace of its output expansion to curb the rise in oil prices. And OPEC gave an emphatic no that we will do what is in our best interests. And we've seen oil prices, we saw oil prices rise to about 85, 86 after that. So the U.S., its strategic oil reserve, China has a strategic reserve as well. The U.S., its size is about 600 million barrels, somewhere in Texas and Louisiana. So for times like this, it's typically an emergency measure. But with gasoline prices rising in the U.S. in some states to about $5 a gallon, that's really steep, and it's fueling inflation. The biggest worry in the U.S. now, inflation is at a 30-year high, and they were initially thinking inflation was more transient.
That word keeps going around.
But it's seeming to be structural. We saw fiscal stimulus about 15% of GDP. We saw lending rates come down to zero. The Fed took action to make sure lending rates fell to around zero. So you're seeing that influx of money into the U.S. economy, and you have supply chain disruptions and high oil prices, which given inflation is now 6.2% thereabouts. So the U.S. is trying to align with China to see how they can pump more oil into the market and lower oil prices, which would translate to lower gasoline prices. So in the fact that they are actually, it's rare to see the U.S. and China align on anything.
Yeah, that's quite rare.
So that's how important it is. So the market will wait and see. And then again, how much oil output do we expect from this alliance, so to speak? How much oil output? How long will it last? If you have 600 million barrels of oil, how much does China have? So it remains to be seen, but obviously it's going to have some impact on the market in the near term. I see oil prices fall even lower to back. When it was at 70, we're thinking, this is a high of about 2-3 years, but 80 was really steep. So oil prices may fall to just about $70 a barrel in the next month. We might see oil about $70 a barrel.
I was expecting at least $90 by now, but now we see the U.S. trying to reduce the price, and we see OPEC actually resisting that. Where do you see this going?
I think by the next OPEC Plus meeting, it remains to be seen if the U.S. and China would have taken action by then, and OPEC might respond and begin to. It pumps an extra 400,000 barrels of oil a month. It might take action and say, okay, let's lower that. Let's see where we can strike a balance and keep oil prices between $70 and $75 a barrel. And because, the fate of the economies depend upon it. Most of them are oil dependent, especially countries like Nigeria. So I think OPEC will be forced to take drastic measures in itself. But for the US and China trying to bring down inflation, they will do what they have to do, which is it's just a threat of putting out oil from their strategic oil reserves, even to driving oil prices down. Imagine if it's actually done. So we'll see oil prices between 70 and 75 in the next couple of weeks.
All right, looking at this special petroleum reserves now, what kind of impact can we expect from it? Would it be a short-term or a long-term kind of impact?
Given the size of the U.S. reserve, 600 million barrels, if you release an extra 1 million a day, it would take about 2 years. We don't see that. Typically, the reserve is for emergency measures. So if you act and OPEC reacts and all the other countries react, there comes a time there will be a balance. Then as demand improves in the coming, as you know, there's a global recovery taking place as demand improves, and the supply, there's a supply glut, obviously. The supply glut coming because of the strategic reserve, and as OPEC continues to increase output, unless OPEC decides that it's no longer increasing, then we can say, okay, so that much supply is going to be taken, or that much expected supply into the market is going to be not going to happen. Then there's the case of Iran, that's in talks with the US, and the possibility of the Iranian nuclear deal taking place. So they would obviously want to put back maybe over a million barrels of oil per day. So it's looking more and more like oil prices, supply outweighing or outpacing demand in the coming quarter. And oil prices getting probably below 70. It's a possibility.
No, definitely weigh on price. But I would say the prospect of national lockdowns in Europe, that has also raised concerns about the economic and oil demand growth. How will this all play out?
Well, as the economic recovery takes place in Europe, we're seeing there's a possibility of lockdowns in countries like Germany. We don't know if it's an entire lockdown or strategic specific location-specific lockdowns. I mean, that remains to be seen because it's a new variant of COVID. We don't know if the vaccines, the level of efficacy of the vaccines we already have on that variant. So it remains to be seen. I mean, if people take vaccines and there's a booster shots, we don't know how quickly this variant will spread across Europe. We don't know if it will spread. So the markets will wait to see and anticipate any damage to potential demand, to the demand outlook, and that would weigh on what oil prices will become in the next couple of weeks. I mean, it's rising faster than the pace of increase is faster than the previous variants. So in the next couple of weeks, I mean, if it rises to neighboring countries or spreads to neighboring countries, it becomes a problem. And it weighs on potential outputs in the future, potential demand in the future. And that would really tell on oil prices in the coming weeks.
Lockdown actually have an incredible impact on prices there. But we see IMF in its Article 4 missions called for complete removal of regressive fuel and electricity subsidies. How do you see the government reacting to this?
I think because we've seen higher oil prices, and higher oil prices for us typically amounts to higher subsidy payments. If you want to keep oil prices at 162, if you don't want to deregulate the price of fuel, and if you did that, the price of fuel would probably rise to close to 400 naira per litre. And obviously, that will come with the consequences of inflation and all whatnot, and increased poverty. But it's something that needs to happen if you want to attract investment to the downstream sector, if you want to bring efficiency downstream sector, and take out the subsidy creates an avenue for corruption and smuggling. Over time, this is what has happened. We've seen people being able to take fuel across the border and sell at deregulated prices in neighboring countries. So if you want to remove that opportunity for arbitrage, you need to deregulate the market. You need to remove subsidies on fuel, subsidies on even power. If you want to attract investment in the sector, cost-reflected tariffs are important. And for efficiency, private sector participation, jobs, you need to take away those subsidies that have been in place for a very long time. Obviously, we expect some resistance from labor, even civil society, even people, because of the higher prices. But we feel like eventually it will help government fiscal consolidation efforts. Especially with fuel subsidy, that takes close to, this year alone, it amounts over ₦1 trillion in subsidy payments. So you take away that should add to the federal government's capital spending, maybe on roads, rail, things that will improve the lives of people, could improve competitiveness and the ease of doing business, to attract investments. So yeah, that's...
Well, we're talking about subsidy removal for the longest time now. Mm-hmm. When do you see this happening realistically?
Well, the federal government has set a date of mid-2022. We think it will happen earlier. It was just announced this morning that the government wants to share about 18 billion naira to every state in the country. That's basically the increase in FAC from the anticipated removal of subsidy being shared ahead of the actual earnings. That's basically what's taking place. So we think that, the fact that this has been announced now, it might happen way before the ending of June 2022, maybe as early as January.
So this is like a loan.
It's like a loan. It's like a promissory note to go spend the money in anticipation for the increase in FAC in the future. So that's something we think is going to happen. It has to happen. It just has to happen. Slowly, we've seen the reform, they've been slow. The reforms have been slow and gradual, but it's heading towards where we know that this has to be taken away. We have a PIA that was passed, and one of the stipulations of the PIA is the deregulation or the regulation of the downstream petroleum industry, which subsidy removal is the critical thing that has to be done. If you remove subsidy payments, then you have a deregulated market where it's price reflective, where price is determined by demand and supply. So that needs to happen now and put more money in the hands of government. Obviously, there's a trust deficit. People don't exactly trust the government to spend the money judiciously, but the government needs to be seen to be spending money, targeted areas where people would benefit the most. Transport infrastructure, especially road, rail, even the ports. We know how difficult it is to get goods from the ports to markets or wherever, different places in the country. So if you can be seen to be targeting spending where you solve a problem and people are seeing that the problem is solved, I mean, that trust deficit could be bridged.
Right. Anyway, MPC, we're getting the outcome meeting today. Any sound bites or the expectations?
It would be surprising if there were any change, anything other than maintaining status quo. I mean, we're seeing a positive economic data in growth and in inflation for the 7th consecutive month, even if it feels like prices are surging upwards. But it's base effects, basically, base effects. But that's waning. Over time, the base effects would wane completely, and we might see. So there's that risk that inflation may begin to reverse the trend. Obviously, there's the external risk as well, given that the central banks in advanced economies may begin to raise, some are already raising interest rates, and the US Fed may raise interest rates earlier than expected. And if that happens, we may see currency volatility in emerging markets. We may see emerging markets, just like Nigeria, might now have currency pressures forcing the CBN's hand. Inflation might begin to spike, and the CBN might need to raise interest rates, which would even further fuel inflation. So it's a lot of things hang in the balance at this time, but all in all, we see even there are risks to growth at this point. I mean, the GDP data was positive, but we saw oil sector and agri sector. Oil sector contracted, agri sector slowed. So these are things that the CBN will be watching out for over time. So we expect that there will be no change in any of the parameters in this meeting.
About do you expect anything about e-Naira?
The e-Naira, yeah. I think in time the CBN and the federal government would come up with policies to, they might want to make payments or disbursements, and people might be compelled to adopt the e-Naira or the wallets as, we're going to make these payments and it's going to be via e-Naira. So you better get it or you will not get paid. Those sort of policies, and that's what will compel people to adopt the e-Naira, because I think there's, like I said, the trust deficit. People may not want, a lot of people live in fear, constant fear of the CBN, of the authority, of the government having knowledge of their financial transactions and all whatnot. So,
another fear is if you actually compromise, or if your e-Naira wallet is compromised,
obviously there's
you bear that risk.
You bear that risk, and the CBN was very clear, categorical about that. So there's anything you do online, there's the cyber security risk. So, and if you're told that, look, it's all we have no fault in this, the risk is all on you. So Nigerians might be very reluctant to adopt it. But all in all, I think the CBN would come up with policies to compel people.
Right. Anyway, another burning issue now, we see Nigeria is looking to lure foreigners into the mining sector. What's the plan there?
It's all part of the diversification drive. I mean, the mining sector is a sector that can absorb a lot of labor. It's capital intensive, a lot of equipment required. So it's something that's, given that Nigeria has over 50 different types of minerals across the country. So it's something that can absorb a lot of labor, lower unemployment, help in earning forex. I mean, even if you don't use up the minerals here, you can export them. We have gold, we have cobalt, which is huge in renewable electric vehicles, for instance, and even a lot of in technology, in making phones and all whatnot. So it's huge. Nigeria has huge cobalt deposits. So it's something. It's long overdue that you give incentives to foreign foreign investors in form of import duty waivers and even tax, 3 to 5 year tax waivers. So you attract investments. Nigeria just needs to become more competitive. So what are other countries doing to attract investment? This time that we have the African Continental Free Trade Agreement coming to play. So how do you attract investments as opposed to, okay, I want to invest here. I can go to Ghana or any other country. Why should I come to you? So you attract them. We have problems around insecurity, infrastructure, but if you can give them some incentive via tax, lower import duties and all of that, it would go a long way in attracting foreign direct investment.
All right, we've seen the price of cooking gas spike. Now diesel prices are also on the rise. What's stoking that?
Diesel obviously is the rise in international price of crude oil. Diesel is one of the derivatives. Even there's a global energy crunch at the moment, so that's playing on the price of gas. And like I said, the CBN is keeping an eye on things that could stoke inflation. One of them is cost of energy, cost of gas, cost of diesel. So that risk is high. It's high and it's clear and present, so to speak. So they'll keep an eye on it. Obviously higher diesel costs will fuel higher logistics costs, fueling into inflation as people ripple effect. So that's something the CBN will keep an eye on. It's going to continue. It's just the truth is, in most parts of the world, in every part of the world where there is a deregulated market for the derivatives of petroleum products, fuel prices are higher. Petrol prices are higher than diesel prices. So it just gives an idea of what will happen when we take away subsidy and the market determines the price of fuel. We'll see fuel prices close to 400 naira. Diesel, it's about 340. It's surged about 340 in the past 2-3 months from about just under 300. So when the prices are determined by demand and supply, we will be at the mercy of markets, so to speak, and with no intervention. So it's something we will need to get used to.
All right. So looking at the domestic commodities update market now, can you tell us what's actually happening there?
Okay.
Quickly now.
We were seeing the impact of the harvest season fade off or fade away. In the next couple of weeks, as people begin to plan towards Christmas, increase the buying of commodities, we'll see commodity prices. So we're seeing the price of goods like rice, pepper, tomatoes. They've been falling. We expect those to reverse. We expect the trend to reverse in the coming weeks as people need to double down on Christmas expenses. So that's basically
all right. It's going to be a very interesting Christmas, Nosike, I must say. Anyway, we'll have to leave it there. Nosike Nwajide, research analyst at Financial Derivatives Company. Thank you for coming on the program.
Always my pleasure.
All right, we'll take a moment now. When we come back, we head to the markets. Do stay with us.